Welcome to our Taking Stock video for the week ending the 23rd of August, 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to discuss all things share markets. How are you, Matt, and how are you finding reporting season so far?
It's always a very busy time of year, Kien, but it's great to be joining you again.
Great to have you on board, Matt. But before we get started, just a quick yet important reminder, the information we provide today is of a generic nature and therefore shouldn't be considered personal advice. Remember, shares are volatile, so any past performance figures shouldn't be relied upon as a guide for future performance. Well, Matt, with the third week of reporting season over, a few themes have emerged. Although at face value, companies have generally met market expectations, the corporate outlook guidance has really been softer than expected. These were reflected across quite a few stocks, including Seek, for instance, James Hardie, Origin, QBE, News Corp, Seven West, Cochlear, CSL, and a few REITs as well. So we could go on forever here, but not surprisingly, earnings revisions have been negative over the reporting season as a result of this. And this can be shown on the following chart where you're comparing the earnings forecast trend, and that's in black, to the All Ords index in blue.
Yeah, and despite this somewhat concerning declining earnings trend, Ken, the Australian market has risen back towards its all-time highs, which we see as just further accentuating the disconnect we see between the fundamentals and share prices. And much of the rally across the Australian market has really been a function of the market just following the US market higher as speculators drive up risk assets in anticipation of rate cuts in September and a perfect economic landing. And as we've discussed throughout the year, when investors have priced stocks to perfection, then we see investors need to take disciplined action on their portfolio management and asset allocation.
Yeah, definitely be careful here, Matt. And within the Australian market, though, I noticed some of the optimism has also been driven by the banks, which in total, they contribute to around 20% of the market index. Now, when you're drilling into the results, although the Commonwealth Bank's result revealed a 4% decline in their earnings, a core driver of their revenue, its net interest margins, defied expectations, and it held on steady in the second half at around 2%. Now, net interest margins is the difference between the loan rates they receive and the deposit rates that they pay out. And in addition, we also saw bad debts. They came in lower than expected, and this is providing scope for positive earnings revisions across the banks in contrast to the rest of the market.
But we think the biggest contributor to its positive share price reaction was the $2.50 final dividend, taking the full year dividend to about $4.65. And that's a decent increase on the previous year. And it does take the payout ratio to about 80%. In addition to this, the bank extended its on-market share buyback, but it's now only trading at 4.9 gross dividend yield.
Yeah, and that's because of the share price appreciation. The bank is now trading also at a significant premium to fair value. So a question that has arisen here is whether this premium is justified. And if you break down Commonwealth Bank, it does have a leading market share in deposits and home lending. In fact, it has the highest deposit funding ratio at 77% of total funding, allowing it to access cheaper funding when compared to wholesale rates. And these characteristics suggest that the bank should be trading at a premium to the other banks.
And it is trading at a premium, but it is trading on very lofty price to earnings multiples as well when you do compare that to its historical levels. Hence, we do believe that it will be prudent for investors to take profits if they have an overweight exposure within their portfolios.
Yeah, especially after it's gone ex-dividend, Matt. Let's now turn our attention to some other star stock highlights over the week. I noticed high performance cooling systems business, PWR Holdings, the code is PWH. Its share price dropped significantly after they missed profit expectations. Now, the high operating costs such as increased wages and also raw material expenses did contribute to this profit miss. And given this drop, do you think this could be a good opportunity for investors, or should we be concerned here about the potential risks and those rising expenses?
Yeah, it could indeed present an opportunity, particularly if you do believe in PWR's long-term strategy and their leadership in the high-performance cooling sector. the company's fundamentals do still remain quite strong, and they have solid growth prospects, especially when their planned expansion in the aerospace and defence sectors.
I also noticed, Matt, that this is a founder-led business with the company founded in 1997 by CEO Kees Weel, who continues to have quite a significant stake at around 17% of total shares. And speaking about founder effects, let's now turn our attention to Hansen Technologies, who's also led by the founder and managing director, Andrew Hansen, who currently has a 14% stake in the business. Interestingly, though, its share price rallied despite the company provided weaker than expected guidance for financial year 25.
That they did, Ken, and it was surprising to us, and you don't typically sort of see that on what looks like a guidance downgrade. But there are a few reasons we think for this, and investors might be looking past the short-term issues like the losses from its recent acquisition, PowerCloud, and focusing on the long-term potential for the business. Now, even though PowerCloud is currently a drag on its profits, it could become a significant growth driver in the future for Hansen if they are able to turn around this business.
Yeah, the outlook does certainly look more positive. Plus, the share price is down by about 12% over the year. So it may have been a case where all the bad news is now factored into the share price, and the stock continues to trade at a discount to fair value and could represent opportunity for long-term investors.
And moving our attention to the corporate calendar, there have been plenty of other results this week, including Brambles, Breville Group, Telstra, Super Retail, Coden, Ridley, Objective Corp. So make sure you read our commentary for the full analysis. And the reporting season will be full steam ahead next week. So make sure you refer to the corporate calendar and set up your alerts to keep you on top of all the announcements.
In Under the Microscope this week, we take a closer look at star growth stock Wisetech. Speaking about founder-led businesses earlier, this is another founder-led business founded in 1994 by Richard White in Sydney. The business has grown to be a leader in the logistics software technology space. We originally identified the stock in 2017 at a price of about $5.80, and today it's trading above $120 after releasing quite a strong set of numbers with net profit margins above 25%. So, Matt, how have they achieved this significant growth in such a short space of time?
Yeah, and it's absolutely terrific business, old Wisetech, and one of the best performing stocks in the Lincoln Australian Growth Fund this particular period as well, helping us achieve some very strong results over the reporting period. And we think the competitive advantage really does lie within its flagship product, CargoWise. And although this is quite expensive, it contributes to the business's wide profit margins. Its customers, who are large global freight forwarders, can realise significant value because it removes legacy IT costs and reduces labour costs through digital and automated processes. It also provides customers with real economies of scale by using a more efficient freight system. Clients have less carbon emissions and fewer trucks on the road. Its network structure also covers international markets.
You're certainly a leader in this space, Matt. And Richard White, I noticed the founder of Wisetech Global, is still actively involved in the company as the CEO and executive director. He does have a significant stake at around 35%. And although he has a history of share sales, we are not really concerned given his history. It seems to be quite controlled to support either tax payments or his lifestyle.
Yeah, there's nothing wrong with selling stocks as long as the share price is going up, Ken, isn't it? And Richard's leadership has been instrumental in Wisetech's growth and strategic direction, particularly in its focus on continuous innovation and global expansion, which are key drivers of its competitive advantage. In fact, Wisetech currently spends 35% of revenue on R&D.
Yeah, that's quite a significant chunk in R&D there, Matt. And I also noticed that the company has a history of bolt-on acquisitions. And more recently, such as Bloom Global in the US, they took on also Active Data and Envase as well technologies, which has provided Wisetech with access into key markets and also technology, but has also tested its financial health with its total liabilities to total tangible ratio at elevated levels. And that's really driven by an increase in debt and also those intangible assets, which is now equivalent to around 83% of total assets. So these acquisitions have also led to the dilution of its return on equity, which has now fallen to 13% for this financial period.
Yeah, it's certainly not unusual to see that decline in ROE when you have had so many bolt-on acquisitions such as Wisetech, but it is expected to recover this financial year back above that 15% level, driven by further customer wins and the launch of 3 products, CargoWise Next, Container Transport Optimization, and ComplianceWise.
Yeah, and with the share price having rallied quite strongly on its results, there's no surprise here that the stock is trading at a premium to valuation. And those who are overweight the stock, they should really consider taking some profits off the table. But investors need to be mindful that this stock has historically traded at quite a premium to valuation and also high PE levels. And that's due to not just being a founder-led business, but it's got that technological advancement, very strong growth prospects, and significant global market opportunity as well. Following on from the Commonwealth Bank's result this week and the trading updates from the other banks, an interesting question for investors is, what is the outlook for the banks, and are those attractive dividend yields sustainable?
Very good question, Kien. And to understand this, let's compare some of the key financial metrics using the Stock Doctor platform. You can do this by using the peer comparison table, or you can use our stock filter tool. And you can also use or find the banks under our Star Income stock category by using the watch list view. And as you can see here, both revenue and earnings growth for the banks are expected to be weak in the coming year. And this is not surprising given that CBA have flagged risks on the horizon, including cost of living pressures, higher for longer interest rates, and rising mortgage arrears or late mortgage payments. But the banks are extremely well capitalised, with CBA carrying about 2.2 billion in extra provisions to allow for the worsening economy with rising unemployment. And to put this in context, the provision would cover about 80% of losses in the event of house prices falling about 25%.
Yeah, certainly quite a large buffer there, Matt. And to understand the sustainability of those dividend yields, let's look at some of those key income metrics. The payout ratio for the banks currently range from 73% for ANZ to 85% for Westpac. And although this may appear high, it's not unusual at this stage of the market cycle where the banks prefer to pay out special dividends and also conduct buybacks instead of investing for growth. Apart from ANZ, which is acquiring the Suncorp banking division, dividend growth is forecast to be quite positive. The sustainability of those dividends is further reinforced by the fact that you've got stable and positive earnings revisions across the banks over the last 3 months.
And based on these key metrics, we can conclude that dividend payments are sustainable despite a slowdown in earnings growth for the coming year. Currently, Westpac has the highest gross dividend yield at about 7.8%, but this does include the special dividend of 15 cents per share recognised in the first half. But looking ahead, the FY25 yield is still quite healthy at close to 7%.
Yeah, thanks, Matt. Those dividend yields still look very attractive despite the share price rally across those banks. But that's all we have time for today. And thanks for your contributions. I know you've been very busy with those results as well.
As you have too, Cam, but it's been my pleasure. And if you do have any questions, feel free to tune in into our Lincoln Live webinar on Monday morning.
And just a reminder as well, we've got our virtual masterclass event later in October. So for those who missed out in the Sydney and Melbourne events earlier this year, please remember to register your interest. Lastly, you would have noticed that there is a refer a friend promotion, with the grand prize being a luxury winery experience at the Penfolds McGill Estate in South Australia, with all expenses paid. So our business grows because of you, our members, and we really appreciate your ongoing support and loyalties. In the meantime, have a happy, healthy, and prosperous week ahead.